Hello everyone and welcome to the Compak Asset Management Market Update for August 17th, 2020. Again, as you all know, I appreciate all of you tuning in for the last 32 years that you've tuned into my daily broadcast, which you hear every day all around the country, and you can also go on YouTube and get the daily 1 hour update. That is a 1 hour update where I review the markets, what happened that day. I have great guests every day, and if you have questions, you can always email those to me. That is the daily update for Market Wrap every single day. You can also go to the YouTube, to the Apple Store and download it. All you have to do is type in Market Wrap with Moe, one word, Market Wrap with Moe Ansari. Just type it all together and you'll get the app. It's a free app, and that will automatically download the daily broadcast. Also, do not forget to subscribe to this, to the YouTube channel that you're watching right now, that you can get, whenever I post an update, you will get notified that I've updated the site, and you will get the weekly edition right away. You'll get notified. I'm going to talk about the pandemic update. That is what is driving the markets, but it's sort of subsiding, and that is the good thing, that people, even though the infection rates in a number of states are going up, the death rate is over 170,000 dead, 5.4 million people infected, but seems like it is not as much of a concern. And I will talk about that. I'll talk about the U.S. government, the economy, and the markets, and obviously technical analysis. I'll give you a quick update on where we are technically in the markets. And I've got a new chart for you this week, where we take a look at the U.S. dollar and the implications of the decline of the dollar and what that means as far as your portfolio is concerned. That is something really interesting. You've come to the quarterly updates that I do, or every couple of months I do a long webinar where you can tune in for about an hour or to 2 hours, where I go through all the markets, the economy, and in detail. One of the things that I have talked about is the declining dollar and how you need to change your portfolio to adjust to that. On September 2nd, by the way, I will do another webinar. It's 2 hours, and you can call in with your questions right during the webinar. You can write in your questions, and I will try to answer as many of those as I can. That's going to be on September 2nd, and you have to go to compak.com, COMPAK.com, click on where it says seminars, and register for it. You have to be registered. You have to have a link to get the September 2nd webinar. Let's start with the pandemic and the coronavirus, what has happened to it. Let's start with the updates. One of the things that I've noticed is the countries, if you look at all of these countries here on the red, they are basically countries that have collectivism. By that I mean they've got central governments, they are more socialist or communist, they're controlled by one entity. While you look at all of these countries, the further you go, and the United States is right here, you can see we're on the extreme right-hand side of individualism. That is one of the things that makes our country great, but that is not good for the virus, because like the CCP, the Chinese Communist Party, can make an edict that, hey, everybody stays in, nobody goes out. There's a martial law. Anybody goes out, your neighbor is going to report you, and you're going to be arrested, or whatever is going to happen to you. In the United States, we have the freedom to make the choice. That is one of the things that has hindered us, I believe, in making, because all of us are individuals. We make all decisions individually rather than collectivism. And that, I think, has hindered our response to the coronavirus, which is a great thing when we're innovating things and doing all of these things. But when we have to make a decision as a country, as a state, as a union, then all of us have to look after all of us have to look after each other. Then we get to individualism. Doesn't. But UK and France, you can see they are way up here also. They have individualism, and you can see that their COVID virus rates are a lot higher. So that is one of the big differences why I think we have not done as well with the virus compared to some of these other states that have a lot of authoritarianism, collectivism, communism, socialism, whatever kind of ism you want to call it. But we are individuals, and that's what makes us different. And that's why I think we have not done as well. We moved a lot of trials, 2 more trials, and moved from phase 2 to phase 3, which is good. We have 2 vaccines that have been approved. One is Sputnik 5, that's the Russian vaccine, and there's another one that is a Chinese vaccine. But both of them have hardly gone through what we call phase 1. They've gone straight from phase 1 to phase 3. They have a few hundred people that it's been tested on, say, okay, let's release it. I don't think that happens. It's not good. It's not good science. And that's not, I believe it's not happening in the United States. We've got the FDA. They are looking at making sure that we have thousands of people tested. And that is phase 3. That is where we are right now. And it is all different age groups, people who have underlying conditions, people who don't have underlying condition, all different kinds of tests. So 20 to 30,000 apiece are in phase 3. That's how many people are being tested. Once we get out of phase 3, and I believe it will be in the next couple of months, we should get some approvals. And that is the first step. Just because a vaccine is approved by the FDA does not mean that we will have it available in the United States. We have to manufacture it. That's where we have already made Operation Warp Speed is working. That's the operation by the U.S. government that they've already signed up about 720 million, 10 million doses of the vaccine. And there's a number of companies, AstraZeneca, GlaxoSmithKline, Pfizer, so on. We have bought literally from all of them, as you can see, that's in blue right here, that we've already bought 710 million doses, which are twice as many as we need, and we've spent $9.3 billion already on these vaccines. And you can see the European Union has done the same, COVAX, which is a group of people that have done that, Britain, Japan, and Brazil. So everybody has signed up. How quickly will these companies ramp up? I think a lot of them are already ready to go. As soon as the vaccine is approved, they'll start manufacturing. It will take a couple of months, and I believe it's going to be released in stages where we are going to get the first responders, so as the people who need it the most, then the elderly, people who are most at risk, and then we'll come down from there with the lower risk people are going to get it a little bit later. But that's what I believe. One of the other things that we are talking about here a lot is once we do get the vaccine, are we going to see explosive growth, or are people going to be tentative coming out of that? I believe that we are going to see a lot of people who've saved. We've got about $7 trillion in savings right now that have not been spent. Yeah, there's unfortunately a lot of people that are unemployed, a lot of people that have to get as much money as they can just to pay rent, just to get food. But then there's other people who go out on cruises and vacations and so on, and that has none of that has happened in the last year so far. Will it happen by the end of this year? I don't think so. Till the vaccine comes, and even after the vaccine, I believe there will be people that are waiting and watching to see how everything turns out before they start. But once they start, they're going to make up for lost time. Other people said the opening will be gradual. I think it'll be explosive, and that's going to be very interesting to see next year. Looking at the U.S. government, we still do not have a conclusion. The $3.4 trillion HEROES Act and the $1 trillion by the Republicans, they both left. Now they're coming back to the House. Nancy Pelosi has called the Congress back into session. I don't know if Mitch McConnell is going to call the Senate back, but I think they're both trying to come out with a face-saving way to sit down and talk and make a deal. All politicians love to spend money, love to hand out money. That's what I've seen with every politician, no matter what side they're on. They have it or not, that's a different question, but they love to spend it. So when they have an opportunity like this, I don't think they'll let it go to waste, and they will get it. Now, there are people who need this help, who need to get out, but now there's the question being asked, how much is too much? Why are we giving too much money where we're disincentivizing people for going back to work? Where they can say, look, I can sit home, get the $600 a week, now it's down to $400, $300 from the federal government, $100 from the state. Some states are saying we're not giving the extra $100 because we don't have it. But whatever number, we don't want to say, look, if you stay at home, you make more money. That is not helpful for the economy. That's not helpful for the individual. So I think we are going to see people going back to work as soon as the jobs become available. The airline industry, the cruise industry, the hospitality industry, the hotel industry, I think they'll be slow to recover. But there's other companies that are making up for it, that are growing, that are, as we digitize the world, as our world changes, I used to do these seminars live, and here we are doing this digitally now. So I think that'll change, but that's where we are with the HEROES Act. I think we've got the convention this week, the Democratic convention starting today. Next week we have the Republican convention, and I believe there'll be a lot of rhetoric, but they'll come together with a deal. One of the things that I'm watching, and this is a really interesting chart, the top 5 companies in the S&P compared to the bottom 495 companies. Look at this, just think about this for a second. The top 5 companies are up 35.6% this year. This is as of August 5th. And you can see that their standard deviation, the volatility, is not that high, it's about 9.6. Compared to the 495 companies in the S&P. I'm not talking about small cap companies. I'm not talking about mid cap. I'm talking about large companies. 495 out of the 500, if you collectively look at how they've performed, they're down 6%. So 5 companies are up 36, nearly 35.6. 495 are down 5.9%. That is how big the difference is between the 5 big technology companies and the rest of the market. That's the difference between the 5 large technology companies and the rest of American business. And this is not small cap. Small cap is hurting. They're still much more negative. So as we reopen, I believe that this is going to sort of balance out. Not that I think, as I mentioned last week, I don't think the S&P, the Nasdaq goes down, but it might go sideways. And the rest of the companies might catch up. Something to watch, something to think about. 495 companies down 5.9%, while 5 companies are up 35.6. Here's the PE, or the price to earnings ratio. The top 5 are 32.6, while here we're looking at the rest of the S&P, the bottom 495. So I think, again, the rest of the market is not as valued. If you're in just 5 companies, yes, you've done very well. If you have a diversified portfolio, you should be somewhere in the middle, close to, up 1 or 2% down. Unless if you've got a Holden Hoper broker, well, I'm sorry to hear that, somebody who sold you out of the market at the bottom, you locked in a 30% loss and you missed the 50% up. So 80% behind the market, it'll be very difficult for you to ever catch up in the returns. That's why you need to have somebody who can gradually make the changes for your portfolio, and we are more than happy to do that and help you with that. Let's talk about the technicals, my favorite subject, as you know. Take a look at the charts. Here's the S&P. Somebody had sent me a text or an email during the week for the daily edition market wrap. They said, Mo, you always talk about wave 1 and wave 2, wave 3, wave 4, and wave 5. But you also talk about ABCs. What is this ABC? Well, after we complete a wave 5, like we did on February the 19th of this year, we start what is called a corrective move to the market. If these 5 waves are to the upside, then we start a downward move, and this was A, B, C correction. That's how the markets correct after a 5 wave. So once we've completed 5 waves, which are right here, and this 5th wave, by the way, goes up to about 34.5. We're at 33.80 today. So either we're going to get an ABC correction, or we could start 5 waves to the downside. If we start 5 waves to the downside, that'll be a much longer, prolonged down move. I think we get a corrective move to the downside. That's the way I'm looking at the S&P daily chart right now, and that is my technique. Support right here is right at the 220-day moving average, the 50-day moving average, and the 200-day moving average. How high can we go? Well, nobody knows. I wouldn't guess it. Just stay with the market for as long as possible. Here's a weekly chart of the S&P 500. It has started it's completed 5 waves to the downside, upside, right here again in February. Then we started this ABC correction, and now we're starting 5 waves to the upside. Again, we are wave 3. We could get a wave 4 down here, somewhere back down to 3,200 if we do get a correction, which will be about 7-8%, which I think will not be surprising. August and September, as we get the election anxiety build up, oh my God, if he gets elected, that'll be the end of the world, no matter who it is. And believe me, folks, it won't be. whoever gets elected. And I did a whole piece, and in the next couple of weeks I'll do a complete analysis showing you if the Democrats win the House, the Senate, and the presidency, what happens. If they just win the presidency, not the Senate and the House, then we've got a Republican Senate, not much changes. But if we do get all three, it's a Democratic sweep, then we have to think about what changes, tax changes might happen. They'll talk about a lot. And then if President Trump wins, what happens then? I mean, everybody, and remember the polls last August of 2016, Hillary Clinton led. She had a bigger lead than Joe Biden does at this time of the year. So anything is possible. We have to be prepared for both scenarios. You have to have your plans in place and be able to execute without emotion. That's the hard part. You have to take the emotions out of it. So we are at wave 3. Technically, we could get a wave 4 pullback. If we do, I would still view that as a buying opportunity. Here's the daily chart of the Nasdaq, wave 1, 2, we're in wave 3. We get a fourth wave pullback, which is around 10.4 to 10.2. We close at about 11.2, about 1,000-point pullback, 78% again, is a buying opportunity. I still think all these markets are buying opportunities if you get a pullback. You should be fully invested. You should have enjoyed the ride so far up. You should be positive for the year, even though you've had volatility, somewhere up or down 1%, 2%, I had 2, 3%, wherever, somewhere around there. But if you're down 20, 30%, 15%, you have a problem in your portfolio. Give us a call at compak.com or go to the website, and we'll be more than happy to help, show you what we do. Come to the webinar. Again, we'll show you. Here's the weekly chart of the Nasdaq. Again, we've got wave 3. That's what we're in. We could get a wave 4. Weekly charts, each line is 1 week of trading, and then we can come back and take off from there. But look at where an extension of wave 3 takes us. It takes us to about 12.5K for the Nasdaq just on a short term. Oil, we've come back up, but I think oil is not really a technical picture. It's more supply and demand and politics. One of the things that I saw today was very interesting. China, there was a lot of talk if the Chinese are going to complete the phase 1, all their deal that they made with phase 1. Again, I don't think the Chinese are going to renege on that. They've just hired 20 tankers where they're going to buy U.S. crude oil and U.S. natural gas, liquefied petroleum, that they've decided they are going to import. So that could help up the market, and that could sort of, even though we're hearing a lot of rhetoric on both sides, I think it's more of the election rhetoric rather than real trade breakdown, so we'll see where we go from here. But oil is strictly a supply and demand. Right now we've got plenty of supply, but demand has stabilized, and if we continue to open, the demand will continue to rise. Gold, well, we've seen this incredible run-up in the gold market. We're pushing 2,000 now in gold, but if we do get a pullback back down to about 1850 to 1750, anywhere around there is a fourth wave pullback in gold, which I think we have started. I had mentioned this a couple of weeks ago that I thought gold had made a high, and then we're starting to come back down from there. Here's a dollar. One thing that I did want to talk to you about today was the dollar chart. The dollar has been coming down. It made this high in March, and from there it has started to decline. Now, if the dollar goes into a serious decline, we break below these lows that we set up a couple of years ago in the dollar. We are right about here right now. So if we do start going below these levels, I think that will be a big sign. That would be like gold breaking out above 1350. You heard me on the daily broadcast. When gold broke above 1350, I said, look, there's something changing here. I think we can go higher in gold, and here we are, close to $2,000 an ounce. If the dollar starts to go down, I think for the last 7 or 8 years, and on the long-term webinars that I do, the quarterly webinars that you hear me on every couple of months, the next one is up September 2nd, you can see that we go through 7 or 8 years where the international markets lead and the U.S. market lags. I show those charts going back 20, 30 years. But if you look at what has happened over the last 8, 9, 10 years, the U.S. has way outperformed, outdone the rest of the world. But if the dollar starts to decline, we could see a much better return in some of the European markets, some of the other markets to take a good hard look at those. If you're underweighted, which we have been in our portfolios of international stocks, and good thing we were, because international has underperformed tremendously. But a traditional asset allocation will have 30% of your money in international. Now would be the time to start taking a good hard look at international, but you have to be very selective. You have to do the research on the companies. If you're buying foreign companies, you have to make sure their accounting is correct, that the accounting standards are correct, they have the cash flow, the net worth, and so on. So you have to do a lot of homework, but you have to look at those individual companies, and I think there's some great opportunities. And we have started to move our portfolios. If you're a client of ours, you know how you've seen that we've started to move a lot of that. And something to keep in mind, and I'll go into that in a lot more detail on the September 2nd webinar. That's all the time that I have this week. I'll be back with you on Friday or Saturday morning. We'll notify you as soon as I put the update on. You'll get a notification if you're a subscriber to YouTube. So make sure you subscribe to this channel, so whenever there's an update posted, you will hear about it. Have a wonderful week. Again, don't forget to listen to the daily edition of Market Wrap. I'm Moe Ansari, and I will be back with you next week. Until then, good trading.